There are a number of things for you to consider before applying for finance. But firstly, I'd like to say a few words about credit scoring. Assessing the risk of lending is an important part of deciding whether to provide financing to a customer. Banks and other lenders use credit scoring and credit references to help with this process. All banks will regularly review and update how they assess borrowing requests. Looking specifically at credit scoring is widely regarded as a fair way of assessing customers and borrowing requests. At many banks, there's a regular review and update of how credit scoring is used to make sure that all borrowings offered to customers we believe can repay. Each application is looked at on its merits, but there are things you can do to improve or weaken your credit score, such as ensuring that the turnover through your account is as regular as your business will allow. As you can imagine, if you're a business which banks £100,000 a year, but you only place £30,000 of that turnover through one particular bank, that bank can only see the records for the £30,000. So if you were to make, say, a request for a £10,000 overdraft facility, the scoring system might conclude that your business isn't of sufficient size to justify that particular facility. If you do have an overdraft, ensuring that the balance of your account is periodically in credit and that you don't become overly reliant on your overdraft will be another item to be taken into consideration. And developing a history of successfully repaying borrowing is another positive attribute. So, of course, is the behaviour of your current account. To paint you a picture, you can imagine that a business that always does what it said it is going to do, if it borrows £1,000 and says the account will be back in funds within a week or two, and that actually happens, then the bank is likely to have more confidence for assessing future borrowing requests. Now, if on the other hand your behaviour is such where borrowing is taken which is unauthorised, limits are exceeded, promises are broken, you can perhaps understand that under such circumstances bank systems would take that into consideration when judging any future borrowing requests. Let's look then at some of the actions that could harm your ability to obtain credit. These would be perhaps paying credits into your accounts irregularly or having periods with no credits at all. Cash businesses in particular should be aware that the bank will only see what you pay in and base its assessment accordingly. Going overdrawn without a limit or going over your agreed limit. Running a continual overdraft. These could be an indication that you are not managing cash flow effectively. A loan may be needed to clear the underlying borrowing. Issuing cheques or other payment instructions while there are insufficient funds on your account. Also, your personal account behaviour could also be taken into consideration and included in any overall assessment of a borrowing request that you make. So the moral of the story is just be mindful that the behaviour is in the way in which accounts are operated, even at times when you're not looking particularly to borrow, can have an influence in the overall outcome of the finance request. So it takes time to build a relationship, and you can hear from the information I've outlined that information helps to build up that relationship. One of the other task force deliverables was a lending application checklist, and this has been created to create an idea of the sort of information that banks may wish to see from you when making a lending application. An example of the application checklist can be obtained from betterbusinessfinance.co.uk, and the fact sheet you're looking for is the lending application checklist. You may also find that individual banks have variations relevant to their own particular banks, but the checklist we're about to go through now is a general indication of the sort of information you'll require. If you are applying for finance, you should go through the checklist and look at the boxes to double check that you have gathered all the standard information that you might need. Do note, though, that banks may not ask for all the information in every case. For example, if you're an existing customer, a bank may not ask you for a business plan. If you're interested in applying for finance, you should go through the checklist and double check that you've gathered all the standard information you might need before starting your lending application. So let's move on to the lending checklist. If we have a look at the information firstly for new and existing customers, first outline what you need. It may seem an obvious question, but sometimes businesses haven't given sufficient thought to exactly why they need the money. They may say that it is a cash flow problem, but actually it's a cash flow problem brought about by, for example, a delay in payment by debtors, creditors changing terms, some other aspect which has affected the cash flow cycle. State how much you would like to borrow. Obviously, a financier will want to know what the sum total of the amount you want to borrow is. And this is best determined, particularly for overdrafts, by means of a cash flow forecast. Because by doing a cash flow forecast for a 3, 6 or 12-month period can give the bank some confidence that you've carefully thought through the cash which is flowing through the business, and this will indicate the maximum amount of overdraft or facility that the business is likely to need. State why you would like the finance. This is important so the bank can check that it is suitable business purpose for which money would be lent, and also it does help to decide the type of finance best suited to your needs. When we looked before at the alternative sources of finance, we identified that, for example, an asset purchase might be better financed through asset finance or a business loan rather than an overdraft. State how long you would like the finance for. These can obviously range from 1 to 12 months to very many years, depending on the nature of the finance being requested. The bank needs to know the term of the loan to help assess affordability and ensure the right finance is matched to your business needs. Next, you need to demonstrate your financial viability. This is the area where the bank is determining your ability to repay the finance that's being granted. And some of the information that banks may request to help them do so would be your management accounts, a cash flow forecast, a list of any assets, both business and personal, a business plan, any historic accounts, and finally, do disclose any information that might help your application. It is not uncommon for loans to be not approved simply because some information has not been passed on to the bank. Sort of information that would be helpful in making the bank's decision would be a profile of the owner and the management team, because this helps the bank to assess the capabilities of the team to deliver the business plan, to deliver the positive cash flow that the business seeks to generate. The owner's investment in the business, because this shows the owner's investment relative to the bank's proposed investment. Indicate whether or not security is available, because this shows whether or not you have security to support your proposal, and any other business interests, because this allows the bank to assess any other commitments you may have. If we also look at any additional information that may be required for startups, in essence the information is broadly the same, but in this case it is unlikely, of course, as a new startup, that would be any previous history, so information such as management accounts or historic accounts wouldn't be available. So in these sort of instances for startups, it's more important to have a business plan ready, which then indicates to the bank how the business is proposed to be successful in its particular venture. And indeed for startups, because of course the business is new, then information on the ownership team, the owner's individual investment, and whether or not security available is potentially more important than it may be for existing customers. So let's consider why banks decline lending applications. The main reasons why banks decline applications are, firstly, serviceability or viability. There's no doubt that historic trading performance may not give evidence of being able to repay. Projections might not be tested, the financial strength might be weak, or there may be no evidence of how much a proposition has been thought through, e.g. there's no business plan. Obviously, from a bank's perspective, serviceability and viability is key. There may be adverse customer information. These would be items such as adverse information obtained through a credit search taken through Experian or county court judgments or defaults and other loans. So this is essentially a behavioural aspect. Is there any information that exists which suggests that a business may not be managing their affairs as well as they might? Management capability. As mentioned previously, particularly for startups or existing business looking to expand, this is a key attribute. And this is where a mentor can provide real added value, because a mentor can look at a business plan and the proposition and help shape it and help businesses, but before they come to a bank to obtain finance, to consider the information that is part of the plan and to help shape it and ask the right sort of questions to enable the businesses every chance of success. Sometimes a proposition will be outside guidelines in terms of security or other terms, and this may be a cause of decline if the bank is unable to shape it. It is quite common for banks to ask for security, particularly on amounts for, say, over £25,000, although, of course, individual banks will have their own criteria. Finally, sort of insufficient information. These are relatively simple enhancements that can improve the chances of a proposition being accepted. Maybe examples such as underlying assets in the background, perhaps other sources of income, a sense of business experience, a propensity to save, how much debt the customer likes to take on, what surplus they have in their income. We sort of recognise that many businesses are lifestyle driven, and banks need to be sure there is enough capacity to maintain lifestyle and to meet repayments. They will also go some way towards assessment of character, capability and financial capacity. Other issues which are clearly important is the strategic direction of the business, and the business plan where important. So the business plan where appropriate can highlight aspirations, ambitions, management structure and skill mixes. This can be really important because it relates more to the quality of presentation and of the proposition rather than its underlying viability. This is where you, Better Business Finance, and the masterclasses come in.